All righty, folks, we are going to dismiss a common thought track for those folks in the commercial real estate sector. Maybe somebody who has maybe some skewed opinions because they are on one side of the trade or not, but that is the dry powder, the 9 trillion, the 7 trillion. I've heard all kinds of numbers sitting on the sideline is going to support and be the bottom. And these foreclosures that Jonathan and I have been highlighting that are coming is simply not going to happen because the dry powder won't let it happen. Jonathan, I know you see this a lot. You interact in this space a lot. So let us know about why this argument is still there, and then we can kind of pick it apart.
Sure. So there has been this argument floating around for, by my count, at least 7 years now. I think I first saw it in about 2018 that once, that there's this huge amount of money on the sidelines just waiting to be placed in deals, and it just loves multifamily, and all it wants is multifamily. And this dry powder, and at the top of the market, the argument was, well, the market can't possibly fall because the minute there's the slightest hiccup, all this dry powder that's been just dying to get deals but can't is going to swoop in and grab up all those deals, and the market can't possibly fall because of all this dry powder. Well, what happened, folks? Interest rates went up. Values went down by between 20, 30, 25 and 40%.
For sure.
And the dry powder stays on the sidelines.
Yeah, it's really funny because.
But wait a second. Before you get there, it's not over, because
exactly.
the dry powder argument has just morphed into something else, which is which is now I'm seeing some of, well, not exactly the same people, but the people with the same mindset saying, well, the multifamily market is not going to bottom out. It's not going to crash. There aren't going to be foreclosures because all this dry powder that's on the sidelines is going to swoop in and book up the market. And
they're just wrong.
It just never ever goes away. I mean, there's so many reasons why this argument is wrong. First of all, it's a fundamental misunderstanding of why the powder is dry in the first place.
Exactly.
It's not dry because it can't get deals. It will go invest in something else if all it wanted was a deal. This is money that is sitting patiently on the sidelines, waiting for blood in the streets. And it is not going to move until that blood in the streets that it is supposedly going to stop, right, comes. This is all this dry powder is, the small amount of like cash holdings that people who are fully invested in all kinds of other stuff. It's not like these people are sitting around and they're not invested in anything and they desperately need an investment. I mean, they're invested in all kinds of stuff, and they have capital set aside for opportunities, and that's what they're waiting for.
That's exactly right. Again, when you kind of play this story out, there are undoubtedly billions and trillions of dollars of patient capital that are waiting for opportunities. But you're absolutely right. This is the patient capital.
Yes.
This is the capital that saw what was going on in 20 and 21 and basically said, I'm not playing. You guys are idiots, right? I know when the music stops, you all lost your money. I know where
this is going. That's what that money is all about. Yeah.
Oh, absolutely. And again, this capital right now is likely earning risk-free somewhere between 4 and 5%. Yeah. So you're not going to get them to move for a 6 or a 7 cap. That's not happening.
Yeah.
Right? They're going to want 9, 10, 11, 12. And they're going to wait. This is patient capital. The other thing that these people don't realize is they got lulled into a false sense of security because we had so many new investors throw in capital. So the pool looked bigger, right? There was this patient capital at the bottom. All these new people came in when made the pool look bigger. Guess what? All those new people busted out, gone. You will not get a penny from them again. So you need a new set of people to come in, and they're not coming in this environment. So you're just left with a small pool of patient capital.
And not just that, right? But let's then dig down further into what this patient capital is looking for exactly, right? This patient capital is looking for, to pay 50 cents on the dollar on like busted out brand new Class A construction, like sitting on Broadway in
Yeah,
Manhattan,
exactly.
right? Right. It is not going to touch the C class and B
No.
class workforce housing from the 1970s and 1980s, right? That stuff is going, when the foreclosures start, that stuff is going to 50 cents on the dollar.
Oh, at least 50 cents on the dollar.
I'm saying it right here. That stuff is going to 50 cents on the dollar when the crash comes, when the foreclosures finally start. What this patient capital is looking for is stuff that they can buy at an amazing price and hold on to for a very long time, right? Because
Yes.
it's patient capital. It's not looking like, oh, we're going to buy it and we're going to flip it. Because that patient capital is like, it's waiting for something it can be
Yes.
invested in for a while and earn generational returns on. It's not looking to like quickly flip and then have the same problem all over again of waiting for something else to invest in for 20 years.
They're thinking
right?
decades. They're absolutely thinking decades.
So that capital it has a narrow buy box. It's looking for high quality stuff, well located stuff.
Agreed.
And it's not going to just rush in because, C class multifamily goes to a 10 cap, right?
No,
it does not want that stuff.
It just doesn't want it. I mean, you could probably take it to a 15 cap and they're like, hey, I know how that story ends. I don't want those headaches.
Well, not just that, like those deals aren't big enough, right?
Good point.
Yeah. I mean, the deals are just not big enough for that capital. I mean, when you're talking about the amount of the pools of money, I mean, you're talking about institutional capital, right? They're looking for, $50, $100, $200 million deals that they want to buy for half that price, right? They're not looking for like, 150 units of 1980s built multifamily in a suburb someplace, right?
No, second, third tier city, not interested.
And they're not even looking for portfolios of that stuff, right?
Yep.
They're looking for, top-notch assets that they can buy on the cheap and hold for a generation. So the whole, it's just shocking to me that the dry powder argument continues to persist because it just keeps on getting proven wrong.
Yeah.
Right?
Yeah.
But it doesn't go away. So
there's two other things that are important about this argument is not only the dry powder argument. And again, that dry powder is nothing but equity, but you've also got to be able to get a loan.
Yes.
And, right now, Class A is again trading at, call it 30% blended discount. Class B and Class C aren't trading, but going sub 50% off. Just wait until those. Think about a deal that was $2 million Class C. Now it's going to go for $1 million. You're going to be able to get a loan of like $600,000.
Yeah.
Right. Yeah. Right. Which is 30% of the 2 million price sold in 21. These loans are going to be 60 cents, 60% LTV, maybe 55. Yeah. They're just not going to want to play.
Or you're going to need you're going to have to be a very strong borrower. Right. Yeah. And I just don't, the strongest borrowers are not going to be buying that stuff.
No, exactly.
Right? And anybody in the last cycle, like the folks that I know who kind of cut their teeth on C-class stuff, they're all moving up the value chain. Right.
Oh yeah.
They're all, well, not just that, but I mean, they've kind of they've made money. Now they see the difference between, like workforce and Class A housing. There's a lot of Class A housing, coming to the market. Like they're moving up the value chain. You see this literally, I saw the exact same thing happen in the last cycle where the really smart investors were selling out of, at the bottom of the market, they were selling out of B and C, stuff that they'd held for a while. They didn't get the top dollar price. They missed the peak, but they didn't care because they were making money. And what was more important was that they could then buy something really high quality in a 1031 exchange. And that's what they're looking for. And I think now so what the market will kind of depend on is like the whole thing starting all over again. A bunch of new people who think they know everything, but really know nothing coming in and like, look at the cap rates on C-class property. They're so much better. And, I'm going to make more money. And so, and the whole thing sort of has to, it's like the market has no memory.
Correct.
Right?
Yeah.
Because people age out of it and new people age into it. So, I don't know if you've read Howard Marks's book, The Mastering the Market Cycle.
I did. Yeah. Years ago.
You should read it again. I mean, I'm actually reading it for the first time, but he talks about this phenomenon that like markets have no memory because people age out and then new people come in. And And the young people who come in will, like, if an older person tells them like, hey, this is what's going to happen, they're like, yeah, right. Okay, boomer. Right?
Yeah, exactly. Boomer.
And then by the time, the next one happens, then they're the boomer and they're telling like the next generation and the next generations. Yeah. Like, okay, Gen Zer, okay, Gen Alpha,
Exactly.
what do you know? You don't know anything. You're old. So,
exactly. Yeah. Well, the other thing going on, I'm sure you've been paying attention to, is the bond vigilantes are getting pretty antsy, right?
Yeah.
They first were antsy about tariffs, then they were antsy about China. Now they're antsy about this big, beautiful bill proposed by Trump, and had a horrible 20-year auction yesterday. The 30-year note is almost at an 18-year high. I'll say that again. The 30-year note is almost at an 18-year high. What does this mean? Well, it just means that dry powder is going to want a bigger return.
Yeah.
If rates are going up, that just means the cap rates have to go up also. It means discounts.
The risk-free return, which is something that like the millennial investors and the Gen Z investors are now learning about for the very first time, because there wasn't one for the entire last cycle.
Right.
They're learning about the risk-free, the risk-free premium that you have to beat for any kind of investment. And the risk-free return, right? So now there's a meaningful risk-free return. We haven't seen that in a long time. And it's just going to push everything that's riskier than that has to justify its existence with a really fat return. And what we're seeing now is part of the reason that the markets have kind of seized up is that there's no capital for C-class multifamily where the seller is trying to sell at a 5 cap, or even like, hey, I'm being really aggressive, I'm pricing it at a 6 cap. You're not, if your debt is at 6 and the risk-free return is at 5, right? A 6 cap is not moving. That thing has got to go to an 8 or a 10 cap, and that means foreclosure. That means means foreclose, wipe out the equity, wipe out part of the debt, sell for 50 cents on the dollar. Then the returns make sense.
No, I couldn't agree more. And again, the other thing going on when you think about the debt picture is just this cost. The other thing that I guess I want to talk about, Ray Dalio. Ray Dalio has been out in force the last 48 hours, warning that the Moody's downgrade is not actually highlighting the real risk. And the real risk, to kind of, close it quickly, is he sees the Fed getting into a tight spot. He sees the fact that rates are going up and the fact that that's bad for our economy, getting to a point where the Fed has to print money and become the buyer of last resort, forcing rates lower. And if we do that again, Dalio's like, buckle up, inflation 2.0, inflation's coming. And Ray's pretty concerned about the Fed turning on the money printer again. Have you thought about that? I mean,
yes, not, I didn't see what Ray said the other day, but I have thought about this very issue, right? If interest rates go down in this environment, or they start printing money and they blow up another bubble, right? There's just, I don't really even want to think about it. It's just really bad news. Yeah. To have inflation get out of control, right, is just, then we'll be back in the 70s. You and I lived through that as kids. It's not fun, right? And
not fun.
Could be where we're headed again, right? And obviously some of this has been built up over years of government not being responsible, but also part of this is like a cell phone of the last 6 months. We're kind of like, given the situation that we're in, let's take the exact wrong public policy, like for the position that we're in, right?
Yeah.
So, when you speak about the bond vigilantes, it actually raises kind of an interesting sort of theoretical point for me. When this happened in England last year, 2 years ago.
Yep.
Right.
Yeah. Truss, when Truss came out with their budget. Yeah.
Yeah. And the bond market went nuts. And guess what? The Tories just booted her out as fast as you could blink.
It was crazy how fast she was gone. Yeah.
In our system, we're stuck with this for another 3.5 years, right? And the guy in charge, his brand is that he doesn't listen to anybody, right? So he just does what he thinks is right, and doesn't matter if it's right or not. It's like
Well, that's why the bond vigilantes are important, because again, I think the bond vigilantes have flexed their muscle twice already and won. This is the third time.
yeah.
And maybe they're strong enough, if they push rates high enough, that it actually doesn't pass. Right? It goes to a floor vote and doesn't pass. Maybe.
Well, yeah, but I think most likely what will happen is some version of it will still pass, and it will still blow up the budget.
Yeah,
because
$7 trillion.
Because that's the priority. The priority is cutting taxes, right?
Yeah.
And politically, yeah, I mean, there is some part of the Republican Party that would, just dying to slash public services, but that's not politically really feasible, right? So, it's, if tax cuts are your priority rather than fiscal responsibility, right, then
you're going to get what you get. Yeah,
you're going to get what you get, but you're also, I mean, that's the priority. So there will be it may not be a $4 trillion tax cut. It'll be some lesser tax cut, or they'll engage in more accounting manipulation to try to make it look like it's not as costly as it is, the way that they have done in the past with bonus depreciation expiring, which somehow made it better from an accounting perspective, even though then they just renewed it and it's all meaningless, right? But so I think we're in for trouble no matter what, because I think the quote unquote best case scenario is some smaller giant tax cut that kind of like is enough to get Wall Street to kind of like back off a little bit, but it's still going to make the problem worse, right?
No, again, we are in for some very interesting times. Again, I've been very clear with my audience that we're going to have a chaotic 6 months. Thankfully, it's done by the 20th of July. I just heard or read this morning that they expect the final tax bill to be done by July 4th. It is going to be really interesting where the bond vigilantes take this, because they're big enough, right? The bond market is the anchor for all risk-free rate of returns. That's what all rate of returns are based on. And if they get cranky enough, they're going to force the Fed to be a buyer, or they're going to take rates much higher. And both outcomes suck. Can you imagine rates going up 50 basis points, how destroyed the economy would be?
Oh, yeah. I mean,
I mean, crazy.
Yeah, it's going to be nuts. I mean, I think that's so in our system, that's where the
checks and balances,
and balances, such as it is, like the Fed. Of course, if Trump gets control of the Fed, then that check and balance will be gone too. Right?
Yeah, we got about 12 more months of that, right?
Yeah,
Powell's still there. Yeah.
So because unfortunately we have a system in which like the Congress is not actually accountable to the voters, right? And so it doesn't really matter what happens in the economy or happens in something as like obscure as the bond market, because it will have no impact on the people in Congress, because they'll get reelected no matter what, right?
Yeah.
So the only safety valve is the Fed, such as it is. I mean, what we need is like fiscal responsibility. We're not going to get that. So the Fed is going to have to react, and its reaction is not going to be helpful. I mean, in the sense that it's not going to be helpful for like the economy. And then, as you said, you get into the Ray Dalio scenario where the Fed is kind of screwed, because no matter what it does is bad. Either it's going to raise rates and tank the economy, and then it'll lower rates and that'll create inflation again. And it's like, what's it going to do? It's just trying to react to.
Yeah. You either let the economy get so bad that there's a complete cleansing, which probably means 2 or 3 years of pain.
Yeah.
Or you take the other option, which Ray Dalio says is the option they'll choose, and they just turn on the printer, let the dollar depreciate, and we go blow bubbles again.
Both, though. I mean, I think frankly, we could wind up with a situation where they're printing money like crazy, but the economy is also in the crapper because the printing doesn't help anymore, right?
Yeah, that's true. Yeah, there's been studies about all the money printed. It takes more and more money to get a return. Yeah.
Yeah. It used to be like something like, $1 of debt created $4 of economic activity. Now it's like the other way around. Now it's like $4 of debt to get $1. And it's, I mean, listen, some of the stuff that Trump says is correct in that we're kind of here because we decided that we were going to financialize the economy rather than continue to like make stuff. So that's kind of, that was a decision that was made back in the 80s,
decades ago,
under Reagan and Bush. But so we do need to like bring back manufacturing. The problem is can't happen in someone's 4-year term, and it can't happen by government dictate. Right. Yeah. It's got to happen through a combination of like favorable policy and long-term planning and stability, and not changing your mind every 6 months. And that, so it can't happen under those conditions, but like the diagnosis, I think, is correct. It's just that the cure is worse than the disease right now. So,
well, at the end of the day, the patient capital that we started with the dry powder we referenced, I think it's going to stay on the sidelines even longer. The dry powder is not coming off in this uncertain environment. They're going to want more certainty, bigger discounts, and this dry powder is not coming. Not coming soon.
And if rates are going up, it just gives even more incentive to just sit there, and it pushes. It pushes that risk-free rate of return higher, and it means that the deals have to be even juicier, right? Which means pushing prices down. So,
couldn't agree more. Jonathan, where can people find you?
Yeah, please come connect with me on LinkedIn. That's where I'm active, and would love to get a message from you and start a conversation.
There you go, Jonathan. Thank you so much. Take care. Have a good week.
You're welcome. Yep.